This is why you need dividend investing in your life. It's like having your cake and eating it too. Dividend investing lets you earn steady income just by holding on to certain stocks. Imagine getting paid regularly just for being a shareholder. Whether you're planning for retirement or need extra cash flow now, dividend-paying stocks can provide financial peace of mind. In this video, I'll show you how to build passive income step by step. Stick around because this strategy might just change the way you invest forever. Remember to like and subscribe for more Money Smart Basics videos. If you have any suggestions for financial literacy topics, please leave a comment. Stay until the end to receive a bonus tip. Imagine receiving a paycheck just for owning a piece of a company. That's the beauty of stock dividends. It's like getting paid simply for being a part owner. This enticing prospect is what draws many investors to dividend-paying stocks. Before we jump into the intricacies of stock dividends, it's essential to establish a basic understanding of stocks themselves. A stock represents a fraction of ownership in a publicly traded company. As a shareholder, you have the potential to profit in two main ways: capital appreciation and dividends. In simplest terms, dividends are payments made by companies to their shareholders. Think of it as a reward for owning a piece of their business. Companies that choose to pay dividends typically do so on a regular basis, often quarterly. Let's bring the concept of dividends to life with a couple of real-world examples. Imagine you own shares in a well-established company like Coca-Cola. Coca-Cola has a long history of paying dividends, increasing their payments for over 6 consecutive decades. Another example is Johnson & Johnson, known for its stable business model and commitment to returning value to shareholders. Section 1. Cash dividends, the direct approach. Cash dividends involve a company directly paying out a portion of its profits to shareholders in the form of cash. This cash payment is typically made electronically and deposited into the brokerage accounts of registered shareholders. Once the cash hits your account, you have complete freedom to use it as you see fit. Section 2. Stock dividends, growing your stake. Instead of receiving a cash payment, shareholders who are eligible for a stock dividend receive additional shares of the company's stock. By increasing the number of shares you own, stock dividends can amplify your potential for future growth. Section 1. The Dividend Timeline. Navigating the world of dividends involves understanding a specific timeline that dictates when you're eligible to receive these payouts. This timeline consists of 4 key dates: the declaration date, the ex-dividend date, the record date, and the payment date. Section 2. Ex-dividend date, a crucial deadline. To be eligible for a particular dividend payment, you must own the stock before the ex-dividend date. If you purchase the stock on or after the ex-dividend date, you will not receive the upcoming dividend payment. The ex-dividend date is set to ensure that the company has enough time to accurately identify all eligible shareholders before the dividend payment is made. Section 3. Understanding the process. Imagine you're interested in investing in a company called Tech Innovators Inc. On May 1st, Tech Innovators Inc. announces a dividend of 50 cents per share, with an ex-dividend date of May 15th. You decide to purchase 100 shares of Tech Innovators Inc. on May 10th, making you eligible to receive the dividend. Section 1. Signaling financial strength. A company that consistently pays dividends is essentially telling the market, "We're doing well, we're generating consistent profits." This message of stability can instill confidence in both current and potential investors. Another compelling reason companies pay dividends is to attract and retain investors. Dividends can serve as a powerful incentive for investors to choose one company over another. This appeal to income-oriented investors can broaden a company's investor base and potentially lead to increased demand for its stock. Now that we've explored the ins and outs of how dividends work, let's dive into the exciting part, how you can actually make money from them. The most straightforward approach is to simply collect the cash dividends as they're paid out. This strategy is particularly appealing to investors seeking a regular stream of income from their investments. While collecting cash dividends can provide a steady stream of income, there's another powerful strategy that can supercharge your long-term returns. Dividend reinvestment plans, or DRIPs. DRIPs offer a convenient and automated way to reinvest your dividends back into the company's stock, allowing you to harness the power of compounding. Over time, these small, incremental purchases can accumulate into a significant holding. One of the most compelling reasons to consider dividend-paying stocks is the potential for generating a steady stream of passive income. Unlike relying solely on capital appreciation, which can be unpredictable, dividends offer a more predictable and consistent source of returns. This regular cash flow can provide a sense of financial security and flexibility, knowing that you have a stream of income independent of your primary earnings. While the immediate income from dividends is appealing, the true power lies in long-term compounding growth. Reinvesting dividends puts your money to work. New shares earn more dividends, creating a snowball effect. Dividends generate more dividends, accelerating growth. The longer you reinvest, the more powerful the compounding. Not all dividend-paying stocks are created equal. To make informed investment decisions, it's crucial to evaluate potential dividend stocks based on several key metrics. These metrics provide insights into a company's financial health, dividend sustainability, and potential for future growth. One important metric is the dividend yield, which represents the annual dividend payment as a percentage of the stock's current market price. For example, a stock with a price of $100 and an annual dividend of $4 would have a dividend yield of 4%. While a higher yield might seem inherently more attractive, it's essential to consider the company's overall financial stability and the sustainability of those dividend payments. Another crucial metric is the payout ratio, which indicates the percentage of a company's earnings that are paid out as dividends. A payout ratio of 60% means that for every $1 in earnings, the company is distributing 60 cents as dividends. A high payout ratio, typically above 75%, might raise concerns about the sustainability of those dividend payments, especially if the company's earnings are inconsistent or declining. While quantitative metrics like dividend yield and payout ratio are essential, it's equally important to consider qualitative factors like the company's competitive landscape, industry trends, and management team. A company in a stable, growing industry with a strong competitive advantage is more likely to generate consistent profits and maintain its dividend payments. Consistent dividend growth shows a commitment to rewarding shareholders. A competent management team is crucial for sustainable dividend growth and transparent communication. By considering both quantitative and qualitative factors, investors can make more informed decisions. When it comes to taxes on investment income, not all dividends are created equal. The U.S. tax code distinguishes between two main types of dividends, qualified and ordinary. Qualified dividends qualify for a lower tax rate, similar to long-term capital gains. To qualify, certain criteria must be met. You must hold the stock for at least 61 days out of 121 days. This can result in significant tax savings, especially for higher tax brackets. In contrast to qualified dividends, ordinary dividends are taxed at your regular income tax rate. This means that the portion of your dividend income classified as ordinary dividends will be added to your other sources of income, and your tax liability will be calculated based on your applicable tax bracket. The tax implications of ordinary dividends are less favorable than those of qualified dividends, but they're still an important factor to consider when evaluating dividend-paying investments. If a significant portion of your dividend income is classified as ordinary dividends, it's essential to factor in the potential tax liability when assessing the overall return on your investment. Furthermore, it's worth noting that tax laws and regulations are subject to change. What might be considered a qualified dividend today could be subject to different rules in the future. Therefore, it's always advisable to consult with a qualified tax professional to ensure you're up to date on the latest tax laws and how they apply to your specific financial situation. They can provide personalized guidance on optimizing your tax strategy and minimizing your overall tax liability. As we've explored throughout this comprehensive guide, stock dividends offer a compelling avenue for investors seeking both income and long-term growth. By sharing a portion of their profits with shareholders, dividend-paying companies provide a tangible return on investment that can enhance portfolio performance and contribute to achieving financial goals. Whether you're an experienced investor or just starting, understanding the mechanics of dividends, the different types available, and the factors to consider when evaluating dividend-paying stocks is essential for making informed investment decisions. Remember, dividend investing is not about chasing the highest yields, but about identifying companies with a sustainable competitive advantage, a solid track record of dividend payments, and a bright future ahead. Embracing the power of dividends requires a long-term perspective. While dividends can provide a steady stream of income in the present, their true potential unfolds through the magic of compounding. By reinvesting dividends, investors can harness the snowball effect, where dividends generate more dividends, leading to exponential growth over time. This patient and disciplined approach can pave the way to financial freedom and a secure financial future. Now that you've gained a solid understanding of how stock dividends work, it's time to take action and embark on your dividend investing journey. Define your investment goals and risk tolerance. Are you seeking income, growth, or both? What level of risk are you comfortable with? Research and identify potential dividend-paying stocks. Consider dividend yield, payout ratio, and growth history. Diversification is key to mitigating risk. Spread investments across sectors and industries. Stay informed, be patient, and remain committed to your goals. Harness the power of dividends to achieve financial aspirations. Congratulations, you made it to the end of the video. With that, you are ahead of 90% of most people in America. Here is the bonus tip that we promised. Exposing the secret power of dividends. Here's how you can grow your wealth. Dividend investing gives you steady cash flow. Reinvest those dividends with a drip, and you harness the magic of compounding. Watch small payouts grow into big wealth without adding any extra cash. The information in this video is for educational and entertainment purposes only, and is not intended as financial advice. We are not financial advisors, and the content should not be construed as professional financial advice. Always seek the advice of a qualified financial advisor or other professional regarding your specific financial situation. The use of any information provided in this video is solely at your own risk. Please remember to like, subscribe, and comment for more Money Smart Basics videos.